Hello and welcome everyone to another weekly market commentary from StashAway. I have with us again, of course, our Chief Investment Officer, straight from his home, Freddy Lim. Hey, Freddy, how are you?
Hi everyone. Hope you're all doing well, staying safe, and staying healthy.
Yes. At least on my end, we are ready to go out in the world soon, though. But yes, staying safe and staying healthy, that is for sure. We lots of topics to discuss, right? The news, obviously, the markets have been doing phenomenal the last week, and again, starting this short week of trading as well, right? Yesterday, with strong market upside. So lots to discuss there. For anyone else who's maybe not listened to these videos before, we also feature questions from the audience. So if you have any questions after today's episode, please feel free to put them down in the comment section so that Freddy and myself will be able to pick them up in future recordings. But Freddy, let's get right into it. Lots to cover there. I think, yes, markets have been doing quite well. There's news of vaccines, being going the right path, right? Going with positive developments. But there's also been some, more negative news or like a little cloud over the markets as well, but it's not really reacting to it at all, right? And it really started with, over the weekend, China imposing some new security law in Hong Kong. Do you want to give a quick update on what it means and kind of, how does that affect also the US-China rhetoric that we talked about last week, right? Intensifying already before this even happened.
Well, first of all, what laws is China bringing to Hong Kong? That was vague at first. The Chinese just announced that they're going to revise the basic laws in Hong Kong to reflect the standards in China constitutionally. So it came at a time when the US has sternly warned against it. It came at a time when there's a US general election where China bashing is a very convenient thing to do to gain votes, right? So, but the Chinese are demonstrating their firmness as well by going ahead with introducing these laws. Now, what it's going to do is to aim at acts of treason, secession, sedition, subversion. So the measure will seek to counter terrorism, foreign interference in Hong Kong. So these are sensitive issues because it's widely believed that there's so many agencies residing in Hong Kong and they're working for foreign governments, interfering with things in there. So this is a very direct, a direct posture to those forces. Separately, they are considering legislation that would punish anyone that shows disrespect for China's national anthem. And something that's already a crime in the mainland is going to be a crime in Hong Kong. So this will mean that a lot of the protesters in Hong Kong most of them are going to be violating the laws, right? So again, it's a recipe for triggering more Hong Kong protests, as we have seen. And more importantly for international trade are the WTO and its members now. Are they going to argue next that the high degree of autonomy in Hong Kong, right, promised when they hand over, is now violated, and whether Hong Kong's free trade status should be revoked? And that will be a third whammy on Hong Kong's economy, in my personal opinion.
And that's three big ones already this year, right? So they've already been quite struggling there in Hong Kong. Well, thanks, Freddy, for summing that up. The other one that I wanted to bring up was something more closer to home here in this case, Singapore. Obviously, with the three-phase reopening plans of the government, and knowing that still most of the things will be closed through at least July. As it seems, a new budget was being passed, right? Do you want to give a quick update on that and how you feel that is for the economy here?
Yeah, I was on Channel News Asia yesterday before they're going to announce it, and I expected 5.1 billion in terms of additional new budget. It came in at 33.1 billion, so it was shock and awe. The 33.1, if you add it up to all what they have done previously, total of 63.7, now you plus 33.1, that's $96.8 billion. That's equivalent to almost 20 to 20.5% of the Singapore's GDP per year. And that puts you at close to 2.5 months of total loss of output for the nation. So what you can do is to say, we're going to shut down or circuit breaker for three months, and we have seen 90% drop in activities, then I would need close to 15.5 to 16% GDP to be replaced. I'm getting 20 to 20.5, so I'm getting more than what I've seen, right? So this is very welcome. But at the same time, it's created some bustle in the professionals trading world, where people are worried about the Sing dollars, whether it's now more percentage of GDP is printed, it's catching up to the US, with the Sing dollars that appreciate against other trading partners.
Yes, thanks, Freddy. Good. So for market updates, I think that really covers everything we wanted to. But because we did get a couple of questions that was quite interesting that we wanted to answer today as well. The first one is actually from Milton, and he said, "Hi, Freddy and Philip. Thanks a lot for the commentary. My question for the week is with regards to ESG, right? So environmentally, socially."
Governance,
investments, governance, their relevance coming ahead. Many have predicted that will take a backseat now, right? Because the economy, and now maybe people don't want to look at those issues because they've been kind of pushed out. Where do you see this going in the future, and is there a future of those in terms of portfolios at StashAway?
Now, ESG is part of a thematic world where you have things like aging population, medical advancements, or innovative tech. So these are very long-term structured themes that people want to invest in. But ESG is special in the sense that, for example, the G, governance, in the last couple of years, that play a lot of roles in emerging countries because companies with better accounting reporting standards, more conforming to GAAP than otherwise, they tend to command a substantial premium in their share price versus a comparable competitor in the same industry. Now, however, now that you have the 40% premium, you're paying already for it by investing in it today. So if it's already a very hyped part of the asset classes that's on ESG, it may actually have longer term return implications, right? So for StashAway, we want to view it holistically, where we would look at the team on its own merits. And for example, we introduced China innovations recently into our last reoptimization, as some of you may have known. That's a team that emerges, but it's not just because it's a team that we like. We actually look at the data, the growth rates in the industry, right? We also look at the real world where supply chains disrupted, and then in online businesses and software are not. And so that goes through an investment committee processes before this particular ESG class of ETF is introduced into the portfolio at StashAway. So yes, we are looking at it very carefully all the time. In the longer term, we will do more and more. But we are very conscious of its merits, and also we are also very careful with its valuations. Especially in Europe, where there's a huge wave of ESG now, a lot of the asset classes on ESG may be massively overvalued because you've just seen this whole wave of people idealistically trying to invest in something, regardless of the way it's priced. That can create a FOMO or the wave of inflow that we want to make sure you are protected from. So we will look at ESG, we'll look at its merit, look at its data, we will also look at its valuations versus fair versus fundamentals, and we will come up with a holistic approach over time, right? So that ended in us introducing China innovations, in particular technology from China rather than broad-based China, right? So I hope that addresses how we look at it. We are cautious, we are optimistic at the same time.
Yeah, I think it does. So Milton, I hope this does answer your question. If not, or if you want some more details, feel free to always just reach out to our customer engagement team as well, right? So they're happy to answer any more detailed questions here as well. So last and so final question, Gautam He would like your opinion, Freddy, on with the Fed being ready to print as much as possible, right? Basically saying, hey, we'll do whatever it takes. Do you think inflation hedges such as gold or treasury inflation-protected bonds become more attractive for the long-term hold?
I like gold and tips both long-term. So let me conclude, but not for the potential as a inflation hedges alone. I think as an inflation hedge alone is not enough. First of all, because we're in the middle of a crash, inflation is going to take years to work out, right? So it's sort of a bit premature. But also, as I mentioned before, the printing of money involves the core of the banking system, which involves the velocity of money. As you knew, I mentioned before, in the banking system, we are a fractional reserve system where only a small amount of the system will need to hold reserve and lend out the rest, and the money can keep compounding. And the velocity of money at the moment is 5.2 times, and the US Federal Reserve is trying to engineer it upward. So whatever the Fed do is going to compound faster as they try to change the money multiplying process, right? But that scares you about inflation, but it's a bit premature. That's what I'm trying to say, because the money multiplier works both ways, right? They can, when they sell assets and contract, you also contract multiple times. And in fact, the Fed has to be very careful to make sure the money multiplier goes up now first during the crisis, so that everything they do stimulates more. But on the way out, they got to wait and engineer a decline in the velocity of money. Then they will withdraw stimulus such that it doesn't derail the recovery. So it doesn't. So we've seen it post 2008 crisis, and in the 10-year, people will keep talking about inflation, but it never came. That's because the money multiplier works both ways. So I think that's number one. But I do like gold and tips for a broader reason. Inflation hedges as a potential is one of them. In the case of gold supply demand, we know that the percentage under the ground today, about 50,000 tons left, it costs about 3 to 4x more today to produce it, to mine it, right? We also knew strategically gold is a geopolitical hedge as well. Imagine another Brexit, or imagine the US-China trade war has seen Chinese central bank bought a lot of gold systematically every year. So there's a lot of strategic reason countries are buying gold as a reserve, right? So for those reasons, yes, gold. Tips may not benefit from inflation coming back first, but because it's after all issued by the US government, it does behave like the US government bond. So you can just view it as something with a low income, low coupon, but it gives you a safe place to park your money. And if the world suffers another extreme event, it does provide portfolio insurance purely as well. So it's unlikely to benefit. When there's no inflation, the tips behave more like a low coupon US government bonds. That's what I'm trying to say. And then if inflation comes back, it behaves like that, plus a rising income that's linked and indexed to inflation. So why not? It's a very nice profile to have as part of your portfolio. I hope that answers the question.
Yeah, I think it does. I think, and you make the point at the end, right? So it's part of portfolio diversification, right? So each one of them, has a point of being inside someone's portfolio. So for various reasons, but that's great. To wrap it up for everyone, we have two very exciting webinars coming up, both in Singapore as well as in Malaysia. In Singapore, if you want to join us, and we do it combined together with Nikko Asset Management. It's going to be on Thursday next week. It's going to be a webinar about navigating markets during and after COVID-19. I'm not sure. I think, Freddy, are you joining that with Nikko Asset Management?
Yes, I would. Yes.
Yeah. Okay. So it's Freddy and Nikko Asset Management. So if you want to join that, it's 4th of June, 7 to 8:30 p.m. You can sign up as always on our website, on all our social channels, as well as the links will be posted below this video. So hopefully we will see you there. I think that will be a very exciting one. And then in Malaysia, we have a live webinar on how to plan for your retirement. So how can you optimize and your strategies there when it comes to retirement. That's on the 3rd of June, so next Wednesday, 6 to 7. Again, sign up via the link in the comment notes below. Otherwise, as always, you can find that as well on our website, StashAway.sg or StashAway.malaysia. If you have any other questions, post them in the comment box below as well, so that Freddy and I can pick them up, just like we did for Gautam today. And we will be with you again, of course, next week. Until then, have a safe rest of your week. Bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.